Now that we've done our journal entries, it's time to take a look and determine what the effects on the income statement and the balance sheet were as a result of all of these journal entries. And we already kind of talked about this, but we'll just summarize once again that on the income statement for 2015, the only thing that shows up is this gain on sale of investments. So income in the current accounting period would increase by $1 million as a result of the stock in Shelby Company. And we have this $500,000 increase as a result in the change in the market value of the stock. However, we would defer that gain, kind of. It doesn't show up on the income statement. Instead, it shows up on the balance sheet as an increase in equity to the other comprehensive income account. Okay, so that's kind of a summary of what happened in 2015. There's only one entry to go, and that's in 2016. On the 7th of January, we sold the shares, remaining shares, which are 6 million shares. We sold them for $27 million. So it's going to be somewhat similar to this December 9th entry. However, it will look significantly different. It'll be similar in the fact that we're going to receive cash. Hold on just a second here. There we go. We're going to receive cash and for the entire amount of the proceeds, which is $27 million, because the problem up here tells us that. And we're also going to remove the remaining cost of the investment that it was originally recorded at. So the remaining $25 million has to go away, because logically at the end of the entry, we've sold all the shares, the account should reflect zero. So I'm going to credit this investment account in Shelby. And leave a spot here. Investment in Shelby for the $25 million. But we're off by $2 million. So the question is, where does that $2 million go? We've got a couple of things going on here. If you look back at the T accounts we had from the prior entries, we have a $500,000 sitting in this fair value adjustment account, $500,000 sitting in this unrealized holding gain, and now really we are selling it. So shouldn't we realize this gain is kind of an argument to be made? I'm going to show you what I would typically do, which is there's some area of flexibility here in terms of how we interpret the accounting rules and what we should do. So I'm going to go ahead and credit, to be consistent with what we did the first go around, gain on sale of investments. It's logical, right, that I sold the investments and I made a $2 million profit, because that's what happened. Okay, so I could make a very strong argument that this is the correct entry, and I would agree with that that's correct. However, we're not quite done yet, because what you'll also recognize is this account's been zeroed out, but this valuation account that goes with that original stock investment still has a value sitting in it. So that's really incorrect from an accounting perspective. Now, if we had a portfolio of investments and we owned 10 or 20 or 30 different shares of various stocks, and we had this fair value adjustment account, we would not close this account out, because at the end of this 2016, it's presumed we would make another entry, and at that point we would reconcile out this $500,000 adjustment from the Shelby stock. Or you could make an argument, and I think this would be just fine, you'd have the same net effect on the balance sheet and the income statement at the end of the year, is that once I sell it, I should remove the portion relative to the sale of the stock I just made. So this $500,000 should be credited, right? That's very logical for this stock that we sold. So I could say, okay, take it out of there, fine. What's the offsetting entry? And the offsetting entry is to debit this net unrealized holding gain for $500,000, because it is no longer an unrealized holding gain. It should no longer show up on the balance sheet as an increase in the value of the stock, because we've actually gone ahead and realized the gain. So, and that $500,000 was built into this $2 million gain. So what's going to happen then? You could make the entry here on the same day that you sold the stock, January 7th of 2016. I'm going to debit the net unrealized holding gain / loss for other comprehensive income. So that's for $500,000. And then I'm going to go ahead and I'm going to credit the fair value adjustment account for the available for sale securities to complete that portion of the transaction and netting the value of the stock to zero. Okay, so that's what I would consider all the journal entries up through 2016. We could also then do that same analysis at the end of 2016. What's the total net income effect? And very straightforward here. There's $2 million that we would put through profit in 2016, and subsequently the balance sheet account for other comprehensive income decreases by this $500,000. So that really the net effect on the equity section as a result of this transaction is only to increase the equity by $1.5 million, because this $2 million would flow through to retained earnings as a positive amount, but then you'd adjust out this $500,000 because of the removal of the other comprehensive unrealized gain. So I hope that helps and makes some sense, but that's the extent of the problem.